Welcome back, everyone. This is the weekly performance report. Let's dive into this. There were no new activities to the portfolio for the last week, and on to some commentary. So far, me buying the dip on a few cannabis names was the right move. By the way, I did that in late August, which I couldn't believe it's almost been, 2 or 3 weeks. So that was quick time lapse. The fact that the story is still positively developing, although not positively enough for some, is an indication to me to buy. More and more positive developments keep occurring, and more unanswered questions keep getting answered, and yet the names aren't responding. That is great for someone looking to accumulate shares. If you're not shitting yet, you should probably get off the pot. Of course, I say that tongue in cheek because everybody is waiting for the right time to enter. The problem with that is that they seemingly fail at abstraction and conceptualizing counterfactual universes. What do I mean? What I mean is that many people are waiting for Schedule 3 to pass before they buy. But they fail to understand that when that happens, that the stocks are going to be up dozens of percent. Are they willing to buy into such a strong impulse move? Doubtful. Are they going to wait for a pullback? That's what they'll tell themselves, and if so, when? How much of a pullback? Interestingly enough, they're not ready for any of that. Here they are, and here they've been lying to themselves, saying they'll buy when and if it passes, and yet they won't, and they're clueless of this fact. Now, take for example, Argentina. People were waiting for Javier Milei to become president before buying Argentina stocks. Yet, when it was announced, some of the stocks ripped dozens of percent. Many of these people couldn't stomach buying such a big move, as though they missed it. And here's an image of the Argentina ETF, ticker symbol ARGT. The Argentina ETF popped roughly 11% on the announcement. If you owned the day before the announcement, you'd be up 62% as of Friday, the 13th, 2024. And if you bought the day that the stocks pop, you'd be up 45%. Of course, the next problem would be holding it for 4 months with it trading sideways within a tight range. Many people would have dumped them then too for a quick single-digit percent or 20-odd percentage point gain. But had they had conviction, which came from due diligence, they'd be up 65% in total, an additional 40%. Is whatever they deployed their capital into providing them with a 40% return? Of course, this is an oversimplification, but it goes to illustrate a point. Actually, a lot of points, and I'll let you determine what those points are. I've led you to the water of thought, and you choose whether you drink. So let's touch upon that. I'm going to elaborate a little bit more, but let me elaborate there for a moment. This is what happens. People say some sort of catalyst is going to occur within a sector, or they think there is going to be, but they deem it to be too risky to buy before it is confirmed. And they say to themselves, I'm willing to leave some money unmade if I can mitigate risk. So fair enough. So you could buy before a catalyst and make 100% when it's all said and done after the catalyst develops, or you say I'm going to wait until the catalyst happens and then I'll make 60%. But the risk reward is better. Okay, fine, fair enough. The problem with that is that people seemingly just don't understand. They say, and that catalyst could be pretty much anything. It could be some federal legislative thing, such as in this case. It could be a president, that's pretty federal. Or it could be something like, hey, things haven't been looking too well. I'm going to wait for Q2 numbers to come out and see what's going on with the financials before buying. Okay, fair enough. The problem with that is that, well, there's a few problems with that. But the problem I want to focus on is I don't even want to call it a problem, a consideration, let's just say that, is, okay, the catalyst happens, and sometimes the stock falls 20% instead of going up 20%. And then you say to yourself, whoo, dodged a bullet there. Good thing I did what I did. And then, of course, you also don't want to judge this by any one-off. You take a set of these examples. If in 10 years you're going to bet on 10 different catalysts, then you have to ask yourself, is this a net positive or a net negative strategy? But what happens is instead of it falling 20%, good news happens, it goes up 20%. Okay, now what do you do? If Friday it closes, the good news happens over the weekend, and then Monday happens, and the stock's up 15% out the gate. And then you say, do you hit the buy button? Do you just plug your nose and hit the buy button? Because you thought it was cheap if that catalyst were to develop. So then I wouldn't think, unless you're just playing for a couple of dozens of percentage points, that it going up 15% would now make it expensive. It's psychologically unsatisfying, but if you're having a level head about yourself, then you'd be like, okay, it's up 15%, sure, lost some or missed out on some of the gains, but that's the cost of doing business and de-risking a trade or investment, and therefore I'll still buy on the 15% pop. But that's not what a lot of people do. Instead it pops 15%, they say, dang it, I missed the trade. Oh, you're not supposed to FOMO, you're not supposed to chase things, and then they don't buy. Or they say, well, I'll buy on a pullback. And I don't think I haven't written, I've not published it, and I might have started writing, but it's not a final draft, of buy the dip. Like what's, I think I've made commentary about this before, but what's a dip? I'm dead serious. When someone says buy the dip, what's a dip? Is a 10th of a percentage intraday retracement a dip? Is 1%, 2%? Like, what is a dip? And what you come to find out is no one really knows. I have a dip. I know what a dip is to me. I'm not going to say it out loud. It's part of my proprietary trading. But you need to know, like, is the dip a pullback to the 20-day moving average, 50-day moving average? Is it the RSI getting oversold? Is it a certain percentage point, 5%, 10% from all-time highs? Is it a Bollinger Band, the bottom of the boat? Like, what do you call a dip? So you say, I'm gonna buy the pullback. So very similarly, it's like saying I'm going to buy the dip, and then you have to say, well, what is that? And then maybe it doesn't, Fibonacci retracements. That could be buying the dip, and then you tranche your way into a position. There's all kinds of ways to buy a dip. And then how much capital, the pulls back to the 10-day, you add 10% to the position, 20%, you add another 10%, but there's like 10% of the original or 10% of the cumulative position thus far? Is it 10% as a cost base, 10% of the cost basis, or 10% of the current value of the position? You have to determine all of these things for yourself. So when people say, I'll wait for a pullback, it's like, okay, maybe it rips. Let me see if we have it here. So you can see it popped. November 18th, it popped. And then I'm guessing it probably pulled back for a day. I don't know if you can see my little pointer on my mouse. Probably not, but that's okay. You get a general idea of where I'm at on the screen. Oh, here we go. Zoom. So then it popped. That's the 11% move on the ETF. And then I'm just going to go ahead and call that a 1-day or 2-day retracement. And then you can say, was that the pullback? In this case, thus far, the answer is yes, that was the pullback. And then it popped again. And then you're like, oh man, I was waiting for a 5% pullback and it only pulled back 3.5%. And of course, these are recorded by the end of the day trade. So who knows what happened intraday. And then it ran again, and then it kept running, kind of went sideways for, let's just call it a week or two, and then it kind of went up even more. And then you had a nice little percentage-wise pullback at the beginning of 2024. And then it went nowhere for up 2 months, something like that. And then it kept on testing that floor. And you could say there's no such thing as a triple bottom. Here's a bottom, I guess you could call it. And then you call that one a bottom, and then that one a bottom. And then you could start getting worried. You haven't made money for 2 months. It's looking, double top. and then it has this floor it's putting in, and you're like, oh no, it could break down and blah, 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 and then you sell the shares. So you didn't make any money, you didn't lose any money, you lost a few percent, you made a few percent, whatever. And then that's that 40%. So then you could say from the bottom of this triple bottom, let's call it, all the way to where it is now, conveniently it's at a nice high, I believe that's 40%. Let's see, 50 to, I don't know, close to 70. So yeah, that's 40%. So it's tough. So you wait for a pullback that's higher than the initial pullback that you were hoping to get, and then you sit in no money for 2 months, and then you'll have to wait, and then you do well, and then it pulls back more severely for a month or two, and then it finally runs in the last, let's call it, month or two. So all that happened. Now, this is one example. This is actually what came to mind. I didn't know how well it was or wasn't going to validate what I was going to say, but I was going to put it in here regardless. And this is my point. So you had an opportunity that, and here's another problem. Say you wanted to make something 5% position of your portfolio, and then it pops 11%, and then you're waiting for the pullback, then it pulls back. Are you really going to allocate 5% of your capital or of your portfolio to a shallow pullback? Or are you going to try to wait for a deeper pullback? You could do that with, oh, well, while I'm thinking about it, let's go here. See how well this works out in real time. Oh, year to date, sure. So this is what a lot of people probably want to do. And this is all really worth considering and asking yourself. I wasn't trying to go on much of a tangent here, but nonetheless, here we are. So AMRK gets that, let's just call it the cuppy bump right here. Boom. And then, now I will say pullbacks on news, especially with Buffett. There's some examples when he bought Barrick Gold a few years ago. I remember it was up 7%, and by the end of the week, it was back down to where it was. But when someone buys something who's popular and then other people pile into that trade, that does oftentimes retrace, but sometimes it doesn't. So yet again, what's the catalyst? A respected person within a niche subsector of the investing industry who's participating in small mid-cap stocks, who then announces his investment in something, is the same difference as a Warren Buffett doing so with large cap stocks. Or it's similar enough. How about that? And so you get this run up and you say, crap, missed the move. Or you FOMO, and then, because it's kind of funny. So someone bought it here at 30, oh yeah, I forgot I'm live, so we get the news. So Friday it closes there. Over the weekend on Market Huddle, it's announced. So it goes from 32 to 39. And then, interestingly enough, I actually bought my first shares on Friday. And then it was a small position, like a 1 or 2% position. You'd have to look back. I actually bought it on Friday. And then he made his news on, well, Saturday, I believe, is when it was released. I think I heard it on Sunday, though. Nonetheless, it doesn't matter. He makes his news. So it goes from 32 to whatever it was. So a 20% run up. And then someone bought the shares there. Now, it's funny because you could say, oh, wow, Cuppy's a genius. I love that guy. He's so smart. Okay. So then he got in at a cheaper price because he's so smart. And then he announces it. It runs up. It's now at $39. Did you think he was playing? And then what happens is it goes from $39 and then it retraces, let's just say down here, down 17%. And even though I know the intraday move might have been, I don't know, that's about right. So you're now down, we'll just call it 20%. Ran up 20%. You bought it on the 20% run-up day. Okay. The catalyst has played out. A smart money manager has entered into a position. You sit there and then it pulls back 20%. Over April. So April, May, and then into June. So it's gone nowhere for 2 months. you're down, I'm just going to make easy numbers here. You're down 20% over 2 months. And then what, you dump the position or something because you're down 20% over 2 months and it doesn't feel good. But you really got to ask yourself, this is a guy who plays for multi-quarters or multi-years a position, and he tries to do so for multi-bagger potential. So the fact that you bought 20% higher than it was before he announced his position is like, so what? Oh, now you'll only make 180% instead of 200 some odd percent. Or, it's like the incongruency and inconsistency of people's behavior. Okay, a really smart guy says he bought it, it ran up 20%, FOMO, chasing, whatever, I buy, 2 months go by, I'm down 20%. It's like, yeah, but he wasn't, I think he even wrote somewhere that maybe it'd be a $200 stock or something like that. So it's like, okay, you bought at 40 instead of at 32, and then it's like, that does make a difference. If you bought at 30 and it goes to 200, then what is that? That's a rough 600 and, I don't know, 50% return. And if you bought at 40, it's a 500% return. So you lost 150%. That is the difference between buying 20% too late. So by buying at $40 instead of $32, the difference ultimately is you missed out on an additional 150% gain. All because you were 20% too slow to the move, which is fascinating to think about. But ultimately, you would still make 500%. So whoop-de-doo. But what happens is people get weak, and instead of buying the gap fill, I'm sure somebody was selling it because they thought it was breaking down, or God only knows what. And or a lot of people sold when it retraced to 36 here, or they sold. They're like, oh, if it gets back up there, I'll sell it again. And then they sold it here, and then they're like, oh no, this is a head and shoulders, which I guess it is. And then as such, it pulled back 12% from the head and shoulders. Blah 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 blah. Like, who cares technical analysis? The point is, okay, you followed someone else's trade. They got in at a cheaper point than you, but they play for big money, so you're just going to make less big money. So you hold on to the trade. And if you did buy on that pop, you would now be up, you'd be up 20% as opposed to 43%. But you'd still be up 20%. So you'd be outperforming the S&P 500. Or in line with it at least. And you would have had the opportunity to lower your cost basis on whatever pullbacks, whether it's the neckline of this little head and shoulders, and then down here during the gap fill, and it gap filled again. And I thought there was another intraday at least gap fill here in August. I could be mistaken. And then here we go, August 9th. That seems like that might have been a day. And then you got to think about that. You're waiting for this catalyst. The Cuppy, I'm just waiting for Cuppy to announce this position, and then he announces his new position, and then that's the catalyst. So then do you buy the catalyst? Well, I buy, if you even admit I do whatever Cuppy does, it's like, okay, fine, fair enough. And then he announces it's up 20%, and then do you buy? Do you not buy? Well, then you're like, well, it's already ran. I'm going to wait for a pullback. Okay, then it pulls back, and then, well, that's not, that's a 0.33% pullback, and then that's not enough because it doesn't feel like enough, whatever that even means. And then, I even said at some point in all of this that a gap fill wouldn't be too terribly surprising. And so what I did, I bought here, and then I bought, I think, somewhere in here, so at 36-ish or 37, maybe, I don't know, somewhere in here. Actually, I think I bought at 32. I know I bought at 32, and then I think I waited over here for this neckline, and then sure enough, it created the shoulder, and then it pulled back, and I was like, well, I'll just wait for the gap fill. And then I bought at the gap fill and started running. I was like, I kind of wish I bought more. And then it came back for the gap fill, and I either added more here or over here in June or here in August. I can't recall. And then I believe it's become it's what percentage of my portfolio? 5%? Something like that? 4%? Where is it? Oh, never mind. Almost 7%. So I think okay, well, it's more of a position than I thought it was. I mean, of course, it's up 36%. So I guess I would be right. My cost basis wise is 5% of my portfolio, let's just say roughly. And yeah, if it's 5%, it's up 40%, then it'd be 7%. So we'll just say 5%. So I added a few times on the gap fills. I kind of shouldn't have added to the neckline, but I only added, say, another percent to the position. And it's like, man, if it keeps running and breaks out, because there's also a pattern here of it. Let's just pull up this chart. So you have a clear spot right here, 42, 40, and then that's the 42 after the little pump, or bump. Now I'm saying bump purposefully, not just because I'm trying to be couth and euphemistic, but because it is, and that's a whole nother conversation I'm not going to go down, because, yeah, I'll just say that before I start criticizing other people. So I saw that, I'm like, man, this thing could break out, and if it breaks out, people are going to be chasing. So when there was this little neckline, this is what it looks like on a 5-year chart. This is now the neckline. So I bought the neckline in case it does break out. So if it just tested it to do a pullback, whatever that means, and then test it to then break out. Is it breaking out now? I mean, yes. Does it pull back to retest this old resistance? Could be. I don't know. Will I add? Probably not. But, well, I don't know. And and that's my point. Is it pops 20%, people don't buy, they tell themselves some story, this and that. Hopefully the rambling makes sense to you. With that said, other than that, some more emotionality to compromise and contaminate one's trading. Siboney Stillwater, my goodness, the little drama around all of that. Yeah, at one point this week, I was down 30%, I believe, on my position, and now I'm down 10.7% on my position. And I made it clear whenever I published that article, if it wants to pull down to, I think I said 250, something like, I pretty much said if it pulls back 50%, I'll double my position. If not, I'll just have this little straggler of a position. Maybe I'll add to it ever so slowly here and there. I've not added to it. I think I actually might have added a share or something. I don't know. And not much. And that's what I said. But my God, just the drama around it. Talk about the volatility, and then people tell themselves, if this happens, then I'll do this, and then it happens, and then it's the whole quote about everybody has a game plan until they get punched in the face. But it's like, yeah, I guess, but that's interesting, because that's saying that people's trading or investing, hopefully, is subject to their emotions and fight and flight responses. And let's not lie to ourselves. For the most part, practically everybody is affected by that. So the name of the game is something crazy is going to happen, so you better get your emotions in check while you still can to prepare for that crazy moment. And nonetheless, it was down 30%. I actually thought about adding a little bit. I didn't. I'm building cash up. I think I'm at, oh my God. Oh no, okay. I just didn't scroll up enough. I thought my image wasn't enough. So, what was I going to say? Oh yeah, I'm building cash. Larger portfolio. I finally broke out of this. We'll see if it sticks or not. But I mean, you keep adding enough cash week after week, it kind of starts maybe ever so slowly offsetting losing positions. But I've been in this like 65, 6,600 range for a couple of months now, and finally escaped that at 6,700. Like I said, well, it could easily go back in the range. I wouldn't be surprised. But that was kind of nice. And I mean, assisted by I bought, I think August 27th, if that's accurate, when I bought 3%. I added 3% of my portfolio to the cannabis trade. So True Leaf is up 27%. Vireo is up 12%. I was up like 40% or 50% on that. Now I'm up 12. And then Green Thumb is the laggard here with 8.5%. They're all, 1% positions. Actually, they're 0.8, 0.8, and 0.98, and okay, whatever, 1%. And that's that. Then I have Kinross Gold. That's up. Was that the first one or the second one? No, Tidewater was the first one to hit the 100% gain in my portfolio. Now look at it, up 34%. My God, it's a 66% pullback in the position, which is funny because of the cost basis. And it's not, if you look at all-time highs, it's not down 66%, but that's how cost basis works, as I explained earlier. You know, a 650% gain versus a 500% gain, all because you got in 20% later in the move initially. It's incredible how that works and rarely is discussed. And so Tidewater was the first to hit the 100% club, and then it pulled back. Now it's pulled, at this point, I'm up only 34%, so ouch. And then Kinross was the second. It hit the 100%, and then it pulled back to, I don't know, I remember being at like 80%, so that was a 20% performance pullback. And now it's up 113% altogether, so that's nice. So I think that's my ramblings. So I expounded upon actually having a game plan and understanding what, because you could have the game plan, like I said, by the Catalyst announcement news, but then it's like, that's a very unsophisticated, low-resolution game plan that for all functional intents and purposes and pragmatic purposes is not a game plan. And you don't know it until it's too late, and then people never catch on after doing that a few times to themselves what's going on. So I thought I'd elaborate on it more. Like I said, the Argentina thing was what caught my eye. I would have added the A-Mark precious metals. So if you watch the video, you're good to go, but if you read the article, you're not. So you're welcome, video viewers. And I think that's that. That's the end of my ramblings here. Gone on longer than I planned. So with that said, thank you for watching, and until next time.